Thanks for joining us, and welcome to Raising Capital in 2024, Part 1, Finding Early Stage Equity Investors. Before we get started, Naturally Bay Area would like to thank our generous partners. Their contributions allow us to bring you this educational programming and create opportunities for community building. Special thanks to our newest partner, Vividly, the leading trade promotion and deduction management software for CPG brands. And now, I'm pleased to introduce today's moderator, Naturally Bay Area Board Member Don Booter. Don, I'll hand it over to you.
Thank you very much, Monique. My name is Don Booter. I'm a partner with Davis, Wright, Tremaine, a national law firm with a large food and beverage practice, and a Naturally Bay Area board member. Welcome to our event today. We've got three terrific panelists who bring three very different perspectives on the raising capital question. I'm going to introduce them in a minute and ask them to tell us a little bit about what they do. These three panelists are going to be very valuable resources to each of you as you head down your path of trying to raise capital for your early stage businesses. So we're going to be sharing their contact information, and I encourage you to get to know them over time so they can support you in your growth efforts. So welcome Dianna Tremblay of ICA, Chris Kasuya of Irresistible Foods Group, an affiliate of King's Hawaiian, the investment arm of King's Hawaiian, and Rodney Clark, a principal at Aspect Consumer Partners. And let me turn it over to Dianna to introduce herself first, and then we'll go to Chris and Rodney. Dianna?
Hi, I am Dianna Tremblay. I am the Chief Program and Strategic Initiative Officer at ICA Fund. We're a nonprofit venture capital firm based in Oakland, California, but we work with and invest in companies all across the Bay Area. We run two accelerators to really support companies to get capital ready for our investment. And we do investments, we do convertible notes or direct equity, starting at $25,000 for our very early stage, all the way up to about $1 million, including follow-on. And I'm so excited to be here with y'all.
Thanks, Dianna. Chris?
Awesome. Good morning, good afternoon, everybody. My name is Chris Kasuya. I'm a director in our strategy and new ventures team within IFG. For those who don't know who IFG is, we are the parent company to King's Hawaiian, Grillo's Pickles, Shaka Tea, and now Killer Brownie. We were born out of King's Hawaiian about 3 years ago with the intent to really create opportunities for the King's Hawaiian employees to grow and develop in their career, as well as really apply the lessons learned and capabilities that we've acquired over 75 years of business at King's Hawaiian into irresistible food and beverage brands that share the same qualities as King's Hawaiian. So excited to be here and chat with you all.
Thanks, Chris. Rodney?
Yeah, I'm Rodney Clark, and I'm co-founder and managing partner at Aspect Consumer Partners. We are a San Francisco-based M&A and capital raising boutique, and we focus on working with companies at kind of all stages, but from early stage to late stage, helping them with solve issues in and around growth and how to grow faster and better. And I'm happy to be here today.
Terrific. So as you just heard, we have three different perspectives on this question of raising capital. We have an investment banker who works with companies to help raise capital and also to sell their companies. We have an accelerator that works with early stage companies to help them grow and to help them find capital and also make small investments in them. And we have a corporate venture arm of a larger, privately held CPG company, food and beverage company, in Irresistible Food Group. So three very different perspectives, all very valuable for early stage entrepreneurs who are looking to raise capital in the food and beverage sector. So let's start with you, Rodney, and this is really kind of a high level question, so we can get a lens on what's going on in the capital raising environment for food and beverage companies, early stage food and beverage companies right now, where we sit in 2024. What's your view on that?
Thanks, Don. Good question. I think it's the million dollar question of late. I'd say year to date in 2024, we see some green shoots. We see it getting a bit better. coming off the heels of 2022 and 2023, which were pretty rough years. Swinging into earlier this year was still pretty rough. We've started to see a little some green shoots and some positivity, but activity is still pretty low, to be honest. And it's challenging. What we hear from owners and entrepreneurs is, wow, especially at the very growthier side of the curve, it's really, really tough, and investors are pretty finicky right now, scared of the last couple of years, still some disruption, but we're seeing signs of that abating. So hopefully that gets a bit better as we move on in the year.
Dianna and Chris, any views on that?
Yeah, I mean, look, I would echo pretty much all the same sentiments, and I would say there's clearly a big emphasis on profitability. To Rodney's point, I think we've seen a lot of activity focus on hyper growth brands and companies over the past few years, and a greater emphasis on that. But I do feel like we're starting to see a lot more activity happening from a raise perspective as some of these businesses are in capital constraint situations. So there's, I think, opportunities out there, and especially with companies that have been really focused on long sustainable growth.
And Dianna, what are you starting to see more activity now? And do you think it's starting to pick up after the lull that Rodney and Chris were referring to last couple of years?
Yeah, I think it depends on what kind of business you have. To Leo's point, profitability, strong business model, there has been some pickup. If I look at what we're doing at ICA, we are doing smaller investment in early stage, but we haven't quite slowed down. We're still seeing those opportunities, especially for folks, like I said, they can path out their chart to profitability. They have a really good understanding of their business. And we're starting to see really big deals like Siete Foods. Like that's a different thing, different scale, but we're starting to see that kind of activity too, which is really, really encouraging. Because if you're on that path and you have been working and grinding and being sustainable, you know there is an eventual way to raise that kind of capital.
Yeah, and the deal that Dianna is referring to was a $1 billion acquisition that was just announced the last couple of weeks. Family-owned business that was acquired by Pepsi. So a very happy success story.
Don, could I maybe add something just on because it's not all gloom and doom, but if I could just add something. So we recently wrote an article for the Nutrition Business Journal and talked about a few key trends we're seeing that give us confidence that maybe it doesn't show up later this year, but certainly next year things are getting better. And that is, it's not in the VC market, but it will inform how the VC market starts to move forward. And that is, we've seen strategics as sellers. They're divesting of business, paring back, focusing on core operations. That comes later in the business cycle, later in the M&A cycle, and tends to tell us we're at the end of the downturn and it's going to start getting better. So that's the first point. The second point is we see strategics returning as buyers. And so you see deals like the Siete deal, right? You see, what was the one, Mars Kellanova deal that came earlier this year. You see ConAgra buying Fatty. So now strategics are saying we pared back. Now we're more confident we're going to start buying again. The third factor is we see some of the economic conditions getting better with the Fed reducing rates here, and we're probably going to get a couple more rates, and we see the markets at all-time highs. We're starting to get a better feeling and more confidence in the market. And then we see a bunch of CEOs in the food and beverage space actually coming out publicly saying they're looking to invest, they're looking to grow, and they're looking to make acquisitions. All those things are going to conspire to a much better deal market than we've seen year to date.
And there is plenty of money on the sidelines. There's no lack of capital that's waiting for the right opportunities to invest. They've been on pause for the last few years for all the reasons that we've just discussed, but the money is there and eager to come off the sideline as soon as the conditions and the opportunities align. So, Chris, could you give us your sense of what categories within food and beverage and personal care, product care categories are seeing the most opportunity for raising capital and seem to be the hottest right now, for deal activity?
Yeah, Don, I think, as we've kind of heard from Dianna and Rodney, I think holistically the activity starting to pick up from a category perspective. I wouldn't say that we've seen one outperforming the other or more active than the other. Admittedly, from an IFG perspective, we are pretty targeted and selective on our investment and acquisition targets. So, taking a step back, we really kind of, like I mentioned, focus on companies that share the same characteristics or qualities as King's Hawaiian. And we summarize that in what we call the 5 irresistible attributes. So the first one being an irresistible product, right? So when you put it in your mouth, you go, man, that is the best X, bread, pickle, tea, brownie. So first and foremost, it's food. We think taste is super important. So irresistible product. Number 2, irresistible brand. When you mention the brand name, it might be super small, but that community that it was born and raised in, people love it. They start telling you about their grandma's favorite recipe of that product. So, irresistible product, irresistible brand. Third one, which we always say is the most important and really the core to what makes the companies we have special, is irresistible values. So we look for companies that really have great values instilled in the business, which leads to great cultures within a company. The fourth that I would say makes us really targeted is irresistible location, and we're really focused only on the perimeter of grocery stores. So think produce, think bakery, deli. We don't really play in the seafood protein space all that much, but also we include frozen in that. So really a perimeter play is our primary focus. And the third is what we call irresistible futures. So really brands and companies that have strong gross margins and a pathway to 100 million plus. So from what we've seen, we've definitely felt that the perimeter brands are picking up, and you're also seeing a lot of center store brands and companies looking to potentially, expand into a perimeter positioning or kind of staking their home there, just given the frequency that shoppers have to go there versus some of the necessities that you stock your pantry with.
Great. Other thoughts, Dianna, Rodney, about product categories that seem to be hot right now?
I was going to say one, Leo, I know you guys aren't actively looking at the beverage category as much as other areas, but functional beverages, Don, has been pretty active throughout the year at kind of growthier all the way into, series A, B, C, and D. So there's a number of different financings that have happened, and we've just seen it pretty active.
And how about ICA?
Our core competency, really, a lot of the folks that we work with are food and beverage manufacturers, and or multi-location restaurants. So we consistently see those things. What we're starting to see is more functional items. So functional beverages, functional food, and really for us, it's like, how do you stand out in a market of lots of functional things, and really what is different from your product as well. And we've started to see service businesses too. So you can have natural service businesses just generally too. So we're starting to see a lot of that too.
Terrific. So let's talk about how you do it as an early stage company, how you start the process of trying to raise capital, attract investors. Rodney, do you want to start us off on that conversation?
Yeah, I'd say the first thing probably as you're starting out is you should be thinking about building your network, building it both within the industry to get your product sold, but also those that support and invest in the industry. So groups like Naturally Bay Area and the like are good. LinkedIn is good, but start getting out there and building the network. And the reason that is early on, you'll be working with probably friends and family or maybe someone you know to help finance the business. But as you get a little further on, you're going to have to rely on people you don't know often, that you have to speed date. And it's much better if you've started those relationships earlier. So we'd say, start networking as early as you can, talk to people, get the messaging and the story out, and push that past friends and family and the like. And when you need capital and start to get to capital, you're not building that relationship from the ground level. You already know people, and then they can say, hey, we've known you, we're comfortable with you. Oh, you've done this, see your progress, and you can get finance more easily.
Dianna, Chris,
Yeah,
any thoughts on that?
I can add, you don't know what you don't know. So being able to find programs like ICA's Accelerator or other folks um, that support businesses to really dial in on what they offer, how they're different, getting their finances in order, just being able to speak and understand the language of investors, especially equity investors, so that you can show why your business is investable, show the value that that investor can get from your business as you grow it in partnership. So being able to find, to Rodney's point, find a network that can support you, but in that support also be able to take classes, do 12 weeks of really intensive work so that you actually are able to position yourself really well and your business really well.
Chris, any thoughts?
Yeah, I mean, I would echo what's been shared. I always love the quote, your network is your net worth, right? So I could not agree more around just the opportunity to build relationships. And obviously, in many of the situations, at least in this subject, it's with the hope to find a source of capital. But what I would say is don't be afraid to just build relationships, because you will be surprised. The world runs on the world runs on people, and one person can lead you to the source of capital that you would have never expected, and do so in ways that are unique, because the ultimate driver in a lot of investment opportunities is finding the right person that buys into your mission, your vision, your passion. And the only way you can have that is by having conversations. So certainly would echo a lot of those sentiments, and Naturally Network does a great job facilitating a lot of those relationships. And, you have more traditional pathways like attending trade shows, but those obviously come with capital expenditures. So getting creative on how you meet folks, participating in podcasts, obviously LinkedIn, but just think outside the box. And I think it could pay dividends when you connect with people in ways that people don't expect.
And thanks to each of you for that. Raising capital for founders is long-term agriculture. You have to be planting seeds all the time, regardless of whether or not you're in an active capital raise. You're raising capital continuously, and that's always your second job in addition to running and building your company. There are certain investors who focus on early stage investment, and we'll be talking about that in a minute in terms of categories of investors, but it's always a good idea to start planting seeds with the next tier of investors, private equity, perhaps venture capital, if you're in a category that might be attractive to venture capital, and certainly corporate venture capital arms like IFG is for King's Hawaiian. So let's talk about the kinds of investors who invest in early stage brands and what they're looking for, what they specifically focus on in evaluating an early stage investment opportunity. Dianna, you want to lead us off on that?
Yeah, I can totally. Especially using our experience at ICA and the other co-investors that we're working with. When it's really early stage, we're really looking at the founder first. Are they coachable? What do they know about their industry? Do they have experience in their industry? Are they trustworthy? Do they say what they're going to do? Things like that. But then we're also looking at their team, if they're big enough to have a team. We're looking at their advisory board. We're looking at if they have a board, and if we make an investment, are they willing to form a board? their competitive advantage, what really makes them different, what really makes them so different from the other competitors in the space. You know, people use a lot of time they use the word disruptive when they're talking about their business, but like really what does that mean? What are you disrupting? How are you going to do it, like physically? How's that going to work? We're looking at the historical growth story. You may have only been in business for we do really early stage. We do you have to be in business for about a year before we even start considering. But what's that traction look like already? Do you have product market fit? Are you still figuring that out? If you're still figuring that out, we're probably not the best investor for you. There's other folks who can support you with that. And you know, we're also looking at customer concentration. Is all of your revenue highly concentrated in one spot? What's your plan to get that more evenly distributed? When we do understand that as a startup, early stage, you're going to have concentration. We do know that. But are you aware that concentration is not always great? If you lose one account, do you lose your whole business? We saw that during COVID. Like COVID, very special. But if you're doing all offices and that's who your customers are, you lost all of your business right away. We're also looking at ownership structure. How much of your business do you still own? As you do the consecutive rounds of investment, will you eventually not have ownership? Or is there enough ownership to attract other investors? We look at a lot of other stuff, but those are some of the core things that we're really looking at.
Thank you. Chris, Rodney, other thoughts?
I think that was pretty holistic. And when I just think about for us looking at early companies and some of just our friends in the industry, I'd say one of the things that we've noticed with startups is focus on really building the brand with your hero and core SKUs rather than just trying to get a product extension super quick, right? Especially when you're still just getting that loyal customer or consumer rather, that lifelong fan. It's attractive and a revenue driver to get into other product styles, not aligned, excuse me, just like, you know, different product types, but we really like to see that focus at the beginning.
Great. Rodney, any thoughts?
Yeah, just some overall thoughts to add. Just say, you know, look to a balance of growth and profitability. It's usually a solid business and a healthy business that can balance both. The gone are the days, at least right now, where swinging for the fences and driving big losses. That is going to scare away a lot of investors, especially in this current environment. Two, kind of know where your brand is performing well and why it's performing well there. And know everything about it. Know the customers, know why the gatekeepers at the distributors or the store level, why they like it. Know what's going on with your business. Don't chase doors. Chasing doors all around the country is not interesting to most investors. It does, you know, placate you as an owner and entrepreneur a bit to say, wow, we're really moving. But the key is that second sale and the velocity on those second sales. So if you know where your brand is and where it's performing well and you're focused on that and you're not chasing doors, you're building something special in a certain area or region, and then you can get financing to expand that. And then lastly, I'd probably say where we see a lot of people get tripped up is you got to make sure you have healthy gross margins. And we'd say, look at a fully loaded gross margin. So the accounts will let you put shipping and everything down below. That's not a fully loaded gross margin. Your goods shipped to your customers and sold, that full all-in cost, ex selling expenses, because that'd be contribution margin. But no, that should be healthy. And those are just a few additional things that people would look for and you might want to focus on.
Great insights from each of you. So, Chris, let's turn to the category of corporate venture capital, and that's large CPG companies that have set up investment arms to invest in early stage companies. King's Hawaiian is a great example of that with IFG. So what what's the value proposition from a company perspective, from a founder perspective of partnering with a corporate venture capital arm of a large CPG? And conversely, what is the venture arm looking for that might be different than other early stage investors?
No, it's a really good question. And, I guess taking a step back for some context, as you alluded to, Don, King's Hawaiian IFG is 100% family owned. So as we got into the investment and acquisition space, we kind of played in this weird area of a little bit of VC like, a little bit of PE like, a little bit of strategic like. We probably align most closely with strategic, but I still don't think we're exactly a typical strategic, because one thing we do look at is we invest with the intent to acquire, and we acquire with the intent to hold for perpetuity. So every time we bring an investment opportunity to Mark, our CEO, son of the founder, it is always with the conviction that, hey, your great, great, great grandson or daughter will be super proud that this brand is part of the IFG family. So with that kind of context set, we look for brands starting around. I'll also make a quick commercial. Your comment of it's never too early to start building relationships. We build relationships with companies pre-revenue, right? But we really look to make investments at this stage. Typically it's the $10 million in revenue, net revenue mark. It was 5, and we've kind of increased that as we learn and grow through this investment path, just because of that need to have that strong conviction and really being able to see the sales story from a syndicated data perspective beyond just natural and more into conventional. But what we look for is some of the things that Dianna touched on, just a really strong founder and management team. Because, at IFG, we don't look to just take over that company and, clean house and start pushing our ways on. We actually are trying to build an ecosystem that's completely decentralized. So for the businesses to operate and run on themselves, because we don't have, being a privately held company, a bullpen of talent that we can just completely deploy. And we're also here to, admit that we're not the experts in the businesses that we invest and acquire. And we want that institutional knowledge and passion and story and the history, and really just be more of a good steward to help those brands get to where we think those companies can be. So really would emphasize strong founder, strong management team with, again, those 5 attributes we talked about, with just great values, because values drive behaviors and behaviors create cultures. And we're really keen on that. And I would just side that for IFG, the only team that we do centralize is the sales team, because we believe there's power in our sales team to be able to go to retailers with multiple brands, right? To really own the perimeter and create those cross brand promotional opportunities. So for us, I would say those are kind of the key components that we look for, and kind of the target revenue range.
So Dianna and Rodney, as a kind of a corollary to this question, all money is not equal. There are investors who write checks and don't add value to speak of, and there are investors who write checks and add lots of value. So Chris is talking about the high value added side of the equation, with the kind of investments that they make, where operationally they share a lot of support and information and guidance to their portfolio companies. How do you make that distinction, or how would you make that distinction if you were looking at capital as from a founder's perspective? What would you look for in an investor that would be more than a check?
Yeah, I can go first, or second after Chris. We're really, like, as a founder, I would be looking at and really understanding what I need beyond money. What investor can help me get access to markets? Who can help me commercialize new products? Who can really make sure and help me and support me with a strong go-to-market strategy? who can really help me with resources I need to support my back office so I'm not doing everything? Are there centralized support? Is there an accountant? Is there HR? Really looking at those factors that will help me as a founder do the thing I do really well, which is grow my company and continue to raise capital. Raising capital is a full-time job. So if you're raising and you're around and you're just continuously raising, you need the support of an investor who's really going to be able to be there and give you back office support and functional smart support. Sometimes you just want money and for no one to say anything, but you got to be a certain size for that. When you're smaller, you really do need money that is going to support you to grow in ways that you as a CEO, as you're learning from moving from founder to CEO, that you really need that, that you need that support.
Thanks, Dianna. Rodney, any thoughts on that?
No, I think Dianna summed it up great, actually. Yeah, nothing to add.
Yeah, always look for the distinction between money and smart money. And you want smart money. So our next question, Rodney, is about valuation metrics and how they have been evolving or changing pre-pandemic, during the pandemic, post-pandemic. What are you seeing in terms of how early stage companies are being valued for investment purposes?
Yeah, I'd say, valuation, strangely enough, whether the markets are good or whether they're bad, is pretty much the same. I mean, the way people go about it for early stage companies, the entrepreneurs like to look at gross revenues, the investors like to look at net revenues. We'd say focus on net revenues. That's actually what was sold and what you've actually got out there. But I guess the only real change that's happened of late that tends to happen in the bottom of the cycle or the end of the cycle is, and I think Chris had mentioned it, and it's been focused on here, people start to focus more on profitability and how soon is profitability and what is your profitability profile going to get or going to look like now, what has it looked like, what's it looking like now, and how's that changing in the future? There's more focus on that, and with the sacrifice to just growth that's swinging for the fences. But overall, I think net revenues is where people tend to look at the early stage on valuation until you can get to be bigger and have some more EBITDA. But it's largely the same as it's been, just with the push to profitability and when's that going to happen for you.
Dan and Chris, any thoughts about valuation?
I have just one thought. I think as a founder coming into a valuation situation, of course, you want to get the highest best. And I think just knowing that, and also knowing that it's in some ways a negotiation, but also how do you not alienate a potential investor by going really hard with your negotiation and realizing and understanding what metrics they're looking at and how you can come to a good spot together.
Thanks, Dianna. Chris, anything else?
No, I think we covered this topic pretty well.
Keep in mind that the highest valuation is not necessarily the best investment partner. You may want to take a somewhat lower valuation from smarter money that can add more value going forward. So we'll have one more topic we'll hit, and then we're going to save some time for Q&A. I see there's a number of questions that have been posted in the chat, and we do have a hard stop at 12:45, but we will take whatever questions we can now, and then we'll be available, all of us, after the fact, if you want to follow up with us after the program for some follow-up on some of the questions. The last question I want to start with you, Dianna, which is consumer behavior has changed since the pandemic. How has that change in consumer behavior affected the early stage food venture investment market?
Yeah. So I think a couple of things. As founders are going out to the market, for an investor, for us, really understanding that you understand your customer and you understand their shopping behavior. So at the beginning of the pandemic, of course, everyone was shopping online. We're starting to see people are coming back into stores. So if you're fully just focused on D2C and not thinking about omni-channel, it is we're thinking about what's your thought process. How well do you actually know your customers? Do you know your customers, and do you know their shopping behaviors? So really, knowledge of customer and how they shop and where they shop has become even more critical. And knowing what they like, what they don't like, knowing what your, I think Rodney said it earlier, knowing what your hero product is, and knowing why people are buying that. But really, it boils down to, do you actually know how people are shopping for what you offer, why they're buying it, and where they're getting it from?
Yes, Rodney, any thoughts?
I was just gonna say, I think that was hit the nail on the head just for the sake of time and being able to answer questions. I'm good. I think that was pretty solid.
Great. Thanks. Okay, let's use the last 5 minutes or so to do some of the questions that have been posted in the chat, the Q&A. The first that I want to address is margin targets for companies that are going to be raising capital. What are we seeing in the market in terms of that KPI benchmark that founders should have in mind as an aspiration?
So I can jump in. For IFG, we say the minimum for food is 35% and beverage is 45%. And as Rodney mentioned, we look at gross margin from a fully loaded perspective, so both freight in and out and trade inclusive in that. Now we acknowledge, putting on the founder hat on, that that's difficult, especially when you're trying to grow the brand and get your products into different doors. So if you don't have that, that's okay, but we need to have a really strong convicting story on the path to get there, similar to what Rodney mentioned with profitability, right? So what's your path to break even? What's your path to achieving healthy gross margins? Because you can always tinker things below the line, but if you don't have strong gross margins, your future can become a little bit more cloudy. So that would be my my answer to that.
Any other thoughts, Rodney or Dianna?
Yeah, I'd say we hear from a lot of investors that much the same of what Chris is saying, but we do have people say for growthier stories, we'd like to see at least a 30% fully loaded gross margin to be able to be interesting. Now I will say that that's for a branded manufacturer that sells branded in retail. If you're doing private label and club and retail, you're going to have a mix of those that's going to drag things down a bit. But for branded retail, it should be 30% plus for a lot of investors. That's what we hear, at least.
And then what are you seeing?
I have nothing else to add. It's the same. I think really strong gross margin, so that when you get down below the line and get your SG&A, you have a strong net margin.
Terrific. So a question was posed in the chat about strategic investors. So those are large corporates that may have a corporate venture arm, and whether having them on the cap table as investors may have a chilling effect on the company's ability to raise subsequent capital, or possibly to maximize value in an exit. And then King's Hawaiian is in IFG is in a different category, because they're quite clear that for companies they want to invest in, they also want to acquire eventually. So that's a partnership that they're building that extends beyond the investment relationship. But what are each of you seeing with respect to that question for other corporate venture capital arms? And here we're not talking about venture capital firms, we're talking about large strategics that have investment arms to invest in early stage food and beverage.
And Chris is recusing himself because he's a conflicted party. Is that fair?
Yes, but he's also very clear, as King's Hawaiian is, to their credit, about what their long-term goal is. So there's no ambiguity about that.
So we would say that's a great question, and we struggle a lot with clients as to whether it's good or bad. And we'd say there's a bit of both, right? There's good investments and there's bad investments. So how we tend to coach people to think about it is, when you're going out and raising capital, as Dianna had mentioned, what exactly is it that you need from your investor outside of capital? And who's the best available party to offer that? And is a strategic then the only person you have that's talking to you, or are they best able to provide that? If the answer is, wow, these guys would make a great investor, they can help us with, purchasing, manufacturing, distribution, whatever it may be, then you need to think about, how can the company structure that investment so you have a good partnership, but that it doesn't hamstring you in the future for subsequent raises or a sale, if that's indeed what you're going to do. And there's ways to go about that and work through the documents and make it such that you have a good, healthy relationship and it doesn't restrict you in any way. There's also transactions where you need the capital, a strategic's the only one there. You give them, first right of refusal and some other things that are going to hamstring you that you're going to have to get over in the future. But it can be really good and fantastic, and it can be challenging as well. It's probably circumstantial.
Dianna, have you seen much of this in the market?
Our companies are very small. I would say yes, everything to Rodney said. I think really it's the long-term view. Like, what is your end game? What do you want to achieve with your business? Who are the investors you need to be able to do that? And if a strategic is on that path to everything that Rodney said, how do you make that deal work for you? And if they do have first right of refusal and a couple of, how do you make that work long term? And does that work in your long term view and vision? That'd be the only thing I add.
So corporate venture capital of the nature we're talking about is, by definition, smart money. But I think you have to really understand what the smart is and what the service offering is, because it's not just the check, it's a service offering. And you have to understand to what degree they play to the deal in terms of that, and what value they will add in the process. It's that, every investment is a partnership. But this in particular is a very real partnership. And so you have to be very careful in vetting it. Okay, we're at 12:45 now, and we still have a number of questions. I'm going to share those with our panelists, and we'll try to answer them as well as we can over the next few days. I encourage everybody to participate in the second part of this conversation, which will be on November 21st. It's called Raising Capital, but it's really part 2, but it's actually about trying to obtain debt financing in this market for early stage companies. So it's kind of the second half of the ledger here in terms of how you find money. I want to thank our panelists. I encourage you to stay in touch with them. They are really experts in what they do. And again, we're in 3 kind of different channels here in terms of raising capital, and they can be very valuable sounding boards for you down the road. So please stay in touch with them. And I want to thank them again for their terrific contributions today. So thank you all, and we'll stay in touch. Please continue to participate in the Naturally Bay Area Quick Bite events, of which there are several more through the end of the year, and we'll look forward to seeing you at the next one. Thank you, everyone, and thank you, Monique.